Welcome back to the show this morning. I'm Real Sense Roberts. Dow implied open right now up about 279. Don't get too excited. Dow was down over 1,000 points yesterday. So, not surprising, a little bit of a reflex bounce this morning. Markets are looking much weaker here over the last few days. Nice rally that we had, kind of this bear market rally we talked about previously, and now probably this month we're going to retest lows or maybe even set new lows in markets. So more and more evidence kind of mounting in that direction, particularly as we start to see more and more of the economic data really starting to show up, and we can actually start to assess how much damage there is. We tend to be overly optimistic, and data tends to turn out worse in these type of situations. So we'll see what happens. But I think this comes back, Mike, and we're talking with Michael Lebowitz, CFA, by the way. Also, before I get into this, be sure to go by the website right now. Go by the website, realinvestmentadvice.com, click the big blue banner. I'll say that. But we have the 2020 Investment Summit launching this morning. So the only way you'll get it, though, is to be subscribed at the website. So click it, put your email address in. That's all we ask for. And then we will email you the link right after the show this morning. And that's our 2020 Investment Summit. So, Mike, it's been interesting for the last, and we touched on this in the last segment, but I wanted to dig a little bit more in depth on this because, the Federal Reserve has been talking about for you. So let's back up real quick. After the 2008 financial crisis, the Federal Reserve lowered interest rates to zero, kept them there for 8 years, continued to apply monetary policy to the markets. And these are called emergency measures, right? Quantitative easing, right, liquidity pools, this type of thing. And it wasn't just the U.S., it was globally. So despite the fact we were in the longest economic expansion in history, the longest bull market in history, central banks were applying emergency measures the whole time. And, a lot of things really, when you look back now, you go, things really weren't as operating as efficiently as they should. If you're having to continue to supply liquidity to kind of keep the ball rolling, well, now the trains come off the tracks because of this exogenous event, which we talked about many times here on the show, is that the things that we know about are not the things that trip up the economy. It's the unexpected exogenous event that nobody's planning on that really sends things spiraling out of control. That was the virus. That was the catalyst that, lit the fire, so to speak. Now the Federal Reserve is doing unprecedented. What we thought was unprecedented before is now unprecedented now, and the total amounts and the speed at which the Federal Reserve is acting and implementing measures to try to stave off a depressionary financial crisis. And I guess the question is are they going to be successful?
Right. And Lance, let's just a second. The economic growth through this record-long expansion was anything but record-setting growth levels. Right. It was the worst, the slowest growth levels we have seen over the last, I forgot the number, 10 or 15 post-recession expansions. Right. So despite all the crisis stimulus that was going on in in the mid 2015, 2017, what we just saw last September, which was astronomical compared to anything the Fed has ever done. The economy was growing at the slowest rate. I believe it was like 2.3% annual on an inflation-adjusted basis. So we were starting from a very low level, and I think everyone was just not paying attention to the economy and just focused on asset prices. Bond spreads to treasuries were at the lowest levels more or less ever. Stock valuations were at levels last seen in 1929 and 1999. So everyone was enamored with asset prices because you couldn't do any wrong. Any asset you bought most likely did well, except commodities. And that was with very slow economic growth. That was being fed by deficits that were, especially over the last couple of years, unprecedented for expansion, and monetary stimulus that was beyond unprecedented. So here we are. It's not surprising that an event that would be a huge event in any time in history, don't get me wrong, but it's being the effects are being multiplied because of how unstable we were. And I don't think anyone realized how unstable the economic and financial system was.
Well, I should say that no one realized it because you and I have been talking about this for the last year.
No. I take it back. There are a lot of people, not a lot, a few, there are a few people that realized that it's not just me and you, but there's others. And we you've interviewed a bunch of them. We talk to some of them all the time. But the large majority, especially those in the media, especially those on Wall Street, never mentioned a thing about this.
Yeah.
People with our opinions have been shunned from the mainstream media for I mean, seriously, when was the last time you heard someone saying something like what I just said on CNBC or Fox Business or Bloomberg?
Yeah. Or Fox News or CNN, anywhere. No, that's the issue. And I think you brought up an interesting point that we've talked about here, but I think really kind of commodities did not perform well over the last decade because we've been running exceedingly low levels of economic growth. And, commodities are kind of the telltale sign of an economy, right? So if you've got a strongly growing economy, oil prices, copper prices, titanium, platinum, all these industrial metals, steel, should be at record levels, right? Because we're producing, we're growing, we've got this economic booming growth, right? We've got these record low unemployment numbers, and we've warned for years that these numbers are not really as strong as they appear because your telltale signs of strong economic growth weren't there, and you didn't see it. And you brought this point up a second ago, is that now what we've known was the case is now being revealed in kind of the most ugly of fashions because the underpinnings of the economy were never really structured and strengthened. And, we expanded the use of debt. We expanded the use of this. And, kind of an interesting chart out this morning I put on Twitter was the underperformance of dividend yielding stocks. And throughout history, normally in a bad economic environment or a bad market environment, people tend to hide in, high quality dividend yielding companies for safety. Those stocks have actually underperformed. And we warned about this several times over the last couple of years, that the run to safety in dividend yielding stocks wasn't going to work this time because everybody was there chasing yield for the last decade. So, you have companies like Procter & Gamble trading with tech company valuations, and now that's starting to really kind of come home to roost as well. Companies
like P&G, like all the utility companies that were trading at, like you said, like levels that made no sense for these companies that had the most steady, predictable earnings. And that was across the board. That was in every industry. I mean, whether it was a very conservative company or aggressive, the more aggressive, the even higher the valuations went. But even in the most conservative industries, valuations were just at levels that made no sense.
Yeah. So, kind of looking back at this and, kind of where we are now and trying to help people figure out, we're in this far at this point, and there's a lot of hope that, the Fed stimulus and all this is going to work again. Investors have been trained now over the last decade that every time the Fed does monetary stimulus, that the markets go up. So, this is why you see so many people right now going, oh, you got to buy stocks. You got to be in because the Fed's doing liquidity. One of the questions we've always been asking for the last couple of years is, well, what happens if it doesn't work? Right? What happens, if you put all this liquidity into the system and it doesn't work? Because this isn't 2009. In 2009, we had blown the economy out. Consumer confidence was extremely negative. Valuations had been reduced greatly. And, it was kind of prime in terms of sentiment. People were just convinced the market was going to zero. The stimulus had an ability to really catch there and do some work. We don't have that today. I mean, everybody, consumer confidence is still elevated, even though it's come off a bit, and valuations are still running at 26, 27 times earnings. So, is all this stimulus from the Fed actually going to wind up in the market, or is the hole so big that they've got to fill on the credit side that it's just getting absorbed, kind of like a black hole in space? It just kind of sucks in everything. We'll be right back after the break with Michael Lebowitz. Don't go away.
Was a booty singer, playing little rock and roll band. I never had no problems, yeah. Burning down to one
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.